And that puts us on the issue of silver, of course.
Yeah, and to your point, many of them haven't taken out their 2011 highs. So Agnico, I believe, might be the only name.
Well, many of them have. Most of the silver miners are still way behind, but they're accelerating, like SIL, the ETF of the silver miners. Is it a point of breakout versus GDX? Meaning, if which do I buy, the gold miners, GDX, or SIL, the silver miners? I would suggest silver miners because there's more slingshot effect there, likely, meaning further percent gain than GDX will produce over the coming year or so.
Imagine waking up one morning to see silver not just nudging higher, but absolutely exploding past its old highs, shocking Wall Street and leaving those who ignored it scrambling to catch up. That moment may be much closer than you think. According to veteran market technician Michael Oliver, we are now on the edge of one of the most powerful setups silver investors have seen in decades. Silver miners are waking up, the silver to gold ratio is breaking out, and the charts are screaming that we are about to see a gusher move, the kind that redefines portfolios and shocks mainstream investors. If you've been waiting on the sidelines, this might be your last quiet moment before the fireworks begin.
So let's talk about silver now. The other chart I want to show our viewers is another chart you sent me. It's the silver versus gold. And why don't we take a look at this and then give me some indication of where, first of all, how undervalued silver is in relation to gold and where you think silver might be going.
Well, if you look at that chart, what it shows is pick the monthly close each year that was the highest close of the price of silver relative to gold. And we calculate that by simply dividing an ounce of silver into an ounce of gold, express it as a percent. So you see the scale on the left goes from like, 0 up to 7 or 8 or whatever. And you see these bars, the highest reading you had each year. The lower horizontal line on that grid chart comes through at 2%. 21 of the past 50 years have reached 2%. Right now, we're about 1.16%. Okay. We're very suppressed, very depressed relative to that norm. Okay. And in bull trends, when silver gets going relative to gold, like 79 to 80, 2010, 2011, the spread got up to 3.5%. And back in the 1980, got up to 6% plus. Okay. So just getting to a routine, been there before 21 times in the last 50 years, many of those years not even bull trends, I'd go to 2%. Well, that's nearly a double of the current valuation of silver to gold. What usually happens is when that spread breaks out, and you can't measure it that well on that graph we're looking at. But when we take it down to week action or monthly close to monthly close, and we do an oscillator, a momentum study of the spread, not just looking at the spread, we can see a breakout level not far above where we are right now that says we're going to gush. We're headed sharply toward it. In fact, since April, the silver gold spread has shot up pretty nicely. Silver is up much more in the year than gold is, by the way. Okay. So it's catching up. But there's a breakout level on that spread that says, I'm going to launch. And we define the number in our weekend reports. Once you trigger that, you're going to gush up at least to that 2% level. Probably even further, but let's just say we go to the norm, 2%. Again, that's nearly a double from where you are now. Well, if gold went dead sideways at 4,000, let's say, and silver went to 2%, you do the math. Okay, $80. If silver goes to its norm, gold goes to its normal eightfold bull trend, and let's say it goes to 8,000, which it's done twice before, remember, in terms of ratio. What's 2% of 8,000? Okay. Silver is also well below its 2011 high. The miners just took out their 2011 high. GDX, XAU, gold's way above its 2011 high. And even a bloody base metal, copper, is currently trading above its 2011 price high. Is silver going to stay a dog forever, or is it a mistake? And you and I know, being in markets long enough, You'll find markets that get excessively overdone on the upside and are making a mistake, and other markets that get excessively cheap and cheap relative to other assets on the downside and are ignored and ignored until finally they wake up and you say, golly gee, I wish I'd realized that. Whoosh. And silver, our argument is the technicals argue to us silver between now and the end of the year, in all likelihood, is going to gush past 50 and be in somewhere in the 60, 70 range. And that's not the top. I'm just saying as the first gush. Ultimately, we're going up to that 2% level. The question is, where's gold going to be? And by the way, whenever that spread breaks out, it never is the case that silver gains versus gold because gold goes down more than silver. It always gains because silver goes up net price more than gold goes up. And whenever that spread breaks out, favoring silver, it's usually an indication of verticality in both metals.
And so once again, your message is if somebody has not been invested in silver yet or in silver miners, there's
Get
still
in
lots of
soon.
time. There's still
Get
there's
in,
still
get
the
in.
big move. We've still yet to see it.
We've yet to see it. We've seen an arm wrestling move. You're not too late. Now, there will be a point where the volatility and the price swings will be even more dramatic, but we're not at that point. We're at the
Right.
point now where the gusher, I think, is going to occur. The gusher that takes silver into a new reality and suddenly smacks investors in the face and they say, golly, silver just took out its two old highs, which are relics, really, in terms of how far back in time and the real dollar value of silver in 1980, if it was 50, this many decades later, its real dollar value would probably be 200, okay, just to match that high. Anyway, that's where I think we are, and I think it's not too late, but things
And,
can change quickly in terms of that.
and let's just say gold tops out here in the next few months at $4,000 an ounce. 2% of that would be $80 an ounce. So,
Yeah, in any case, yeah. But I
and
don't
that's
think,
at the low end.
yeah,
It could be
yeah,
3%, which would
yeah,
be
yeah.
120.
But even if you just go to the norm of 21 of the last 50 years, and in the bull market years, it went way beyond that. But even if you just go to 2% again and sort of say, go back up to the surface level, okay? It's a huge percent gain for silver relative to gold. And I think it's underway, and we've started to see it since the beginning of this year. Silver's up a lot more than gold, especially since April. I think it's already begun, and I think that's why you've seen gold miners go vertical, especially since April. Remember, gold made a high in April when we interviewed last time. Gold was up to, I think, 3,400, and it went dead sideways for 5 full months. They sold it and they sold it, thought, oh, this is the top, this is the top. It wasn't at the top, it was just a sleepy range. What happened since then? Miners exploded while gold went sideways. Silver went from mid 30s, lower 33, 34 area for a year. In fact, it had been, in fact, in last May of 2024, it was up to 3270. So you could draw a line across that high through the next year of action, and you did this on either side of it. And it wasn't until late June, July, you finally went through the highs. So July, August, Sep, oh, boom, silver goes from mid 30s to what? 43. Okay. So while gold stood still. Now gold's starting to reassert itself here. But I think that money flow that went into gold miners was from asset managers, largely the larger ones, especially Newmont, which has gone vertical for the last few months, uh, who've decided, hey, they know the stuff you just mentioned. Too many points of excess. I think I'll move 2-3% into the gold miners. They look undervalued. Gold's been doing good. No, I'm not a gold bug, but I'm gonna move some money over there. Well, when they do, it's wet bar of soap time. Squirt on the upside because it's such a small sector. And I think that probably some of the power that's driven that is the doubtful asset managers in the stock market. Can't prove it, just an assumption.
Michael Oliver begins by highlighting that most silver miners are still far below their 2011 highs, even though gold miners and base metals like copper have already surged well past theirs. He points to the SILETF, which tracks silver miners, as offering greater upside potential than gold miners, GDX, because of the slingshot effect that historically plays out when silver starts to outperform gold. The key driver here is the silver to gold ratio, which currently sits at just 1.16%, far below its historical norm of 2%. Over the past 50 years, silver has reached that 2% ratio 21 times, many of those not even during major bull markets. Just returning to that average level would nearly double silver's value relative to gold. And Oliver's momentum studies are signaling that this breakout is already underway. Since April, silver has been rising faster than gold, and a confirmed breakout of this spread would historically indicate vertical price action in both metals. He lays out the math clearly. If gold simply holds steady at $4,000 per ounce, a move back to 2% would put silver around $80 an ounce. But if gold continues into a classic eightfold bull market, as it did in 1976 to 1980 and 2001 to 2011, and moves toward $8,000, silver could easily see $160 or higher. Oliver doesn't think this is fantasy. He believes this is what the technicals are preparing for. Even more bullish, silver has already started breaking above year-long resistance levels. After sitting in the low 30s for months, silver has now pushed into the mid-40s, leaving the sleepy range behind. Gold, meanwhile, has gone sideways for months, yet gold miners have exploded higher, suggesting institutional money is flowing into the sector. Big asset managers have begun allocating 2 to 3% of their portfolios to gold miners because they appear cheap relative to gold's price. Given how small the sector is, this creates a wet bar of soap effect. Price surges higher quickly because there simply isn't enough supply of shares to absorb that level of buying. Oliver warns that the next phase will be far more dramatic. This is the part of a bull market where price moves become violent, volatility spikes, and those who waited too long get shaken out or end up chasing higher prices. Historically, the bulk of gold's and silver's gains happen in the final stages of a bull run, often within a compressed time window. His message is clear. Silver is still cheap, still underowned, and likely about to enter a vertical phase that will shock investors who haven't been paying attention.
Yeah, right now, if you look at a monthly price chart, just a regular arithmetic scale price chart, and it'll go back to 2011 high, and you had the drop into 2015, 50% drop. And from 2015, you worked your way up, but it was an arm wrestling process. In fact, there was 120% correction in there between the early 22 high and it was August 22 low. You went from 2000 down to 1613. Okay, pretty nice drop, 20%. And then you reasserted yourself, but it was an ongoing, arduous process. And only now has it started to look like it's accelerating. And so if you looked at a bar chart of weekly or monthly gold, and you're an average investor, you say, boy, that's been glorious. I'm glad I was in that. And you're thinking, God, it can't go forever like this. But when you look at a ratio scaled chart, in other words, percent gain of a bull market, and go back 50 years when the government approved it for us to trade, God bless them. You've had two bull markets. There were eightfold moves from bear low to bull high, different duration of time. One was from 76 low to 1980. The other was from 2001 low to 2011. But they were both eightfold multiple gains for gold. We bottomed at 1,045 in December 2015. If we get eightfold, it just did what we did twice before for reasons that were far less dynamic and significant to the world fundamentally than what we've got now. You'd be at $8,400 or so just to match what had occurred before. So when you look at the current price chart, you think, oh my God, look how ballistic it is. When you put it on a logarithmic scale chart as we're showing, it's just getting started, guys. We're not even halfway up to the gains we saw in those two bull markets. We're not even fourfold yet. Okay, so that's something to consider. I don't trade off of it. Maybe we're not going to go eightfold again, but considering the dynamics that are out there in other markets, either way, upside or downside, it would be easy to see gold at least matching what it did then. So don't think gold's overpriced.
I'm sorry, Michael, I didn't hear that. So gold's currently at 3,600, 3,700 bucks an ounce.
3,700, yeah. That's a triple, from its low,
A triple from its low. So what would that be?
Well, the bear low in 2015, which is $1,045, so 1,050, let's say. So you've tripled it. Fine, that's great, a little more. But you're nowhere even half what those were. Those were eightfold moves. And a lot of that move occurred in the last year or so of the move. In fact, that was the case in both cases. Most of the move occurred late in the bull trend. So, and again, duration was different. One was a 3.5 year bull, one was a 10-year bull. So, maybe this one's already a 10-year. Um, yeah, and but I think the dynamics are such that what you're going to see over the next handful of months, especially over the next year, in terms of monetary metal upside, is going to be awesome and far different from the tone we've seen over the last 10 years in gold, for example.
So if somebody hasn't gotten involved in gold yet, what's your message to them?
Well, they're late, but on the other hand, it's a reality. Do I get in or not? I suggest yes. Our preference, well, especially when you look at gold miners. Gold miners, we don't have any charts on this, but relative to gold, the valuation of, for example, the XAU index, which has been around since the 1980s. The 1980s, 90s, and well into 2000, like up until about 2007 or 8, it was trading at either side of about 25% of the price of gold. In other words, divide XAU price into gold, it was about 25% of the price of an ounce of gold. It would oscillate above and below there. In fact, the low end of that multi-decade range was about 17.5%. So let's remember that. In fact, when you see the spread chart, if you have one, we publish it routinely. Let's call that resistance now. In other words, if you ever get back up there, you bump your head on it. Okay, where is gold right now? It's like pushing up toward, it's at 7.6, 7.7%, I think, right now, XAU divided into an ounce of gold. So you could double and a half the miners right now on a relative price basis just to get to the underside of the prior multi-decade valuation that they used to have. So they are a vastly underpriced category of the monetary metals. And I think somebody's woken up and said, hey, this is cheap, low risk, I'm in. And that's why you've seen them get goosed. But even getting goosed to where they are, for example, GDX or XAU, just recently, the last few weeks, have taken out the 2011 price high. Gold did that, when it took out 1920. So they're just catching up.
Yeah. So even though a name like Newmont's up over 100% on the year, Kinross is up 140%, Agnico's up 100%,
Yeah.
you still think there's a lot more room to go?
Oh, no, I think they've just begun because all they've done is they suddenly come back to where gold was at about $2,000, back in 2020. Gold's now 3,700. Well, they're just getting up to the 2,000 level. In effect, taking out the $1,920 high we had in 2011 on gold. GDX just took out that high. XAU just took out that high. So in effect, it's saying I'm back, okay, and it's still cheap because if you take 2011 to the present, 14, 15 years or so, and you say, what's the real value of the currency unit we're using? Real spending value, it's decreased markedly because the money supply doubles almost every decade. Well, heck, just to match the 2011 high, you could probably double the current price of the miners and they'd still be where they were in real value terms versus 2011.
So, what should you do if you haven't bought silver yet? Michael Oliver's message is simple. It's not too late, but you don't want to wait much longer. The gusher is coming, and when it does, silver could double or even triple faster than most expect. Ask yourself, do you want to be the investor saying, I saw the signs, but I didn't act? Or do you want to be positioned before the crowd wakes up? If silver even returns to its historical norm against gold, we could see $80 an ounce with gold just staying flat. If gold breaks higher, the numbers become even more staggering. This is your wake-up call. Silver is breaking out, silver miners are just catching up, and the big money is already positioning. The next few months could rewrite the silver story for the next decade. Question for you. Do you think silver will hit $80 before gold hits $8,000? Or will we see both at the same time? Drop your prediction in the comments. I'd love to hear your outlook. And if you found this analysis valuable, make sure to subscribe to the channel for more deep dive updates on gold, silver, and the global economy. The next big move is coming. Don't miss it.